whether you're buying in the north, whether you're buying in the east, whether you're buying in the west, right now is a good time to put capital into Atlanta. And we're seeing that. Atlanta will always be kind of the capital of the Southeast. You have entertainment, film, and music, and not to mention all the Fortune 500 companies, but it's always been a dynamic city.
The best way to talk about Atlanta, you gave a great analogy with the Martini Glass.
North Atlanta, Buckhead, it goes straight north and south. That is your stem of the Martini Glass. That's going to have your highest per capita income. You then have the actual glass, 20. Deals in this pocket, newer construction, we're trading in the 250 to 260 a door range. You can buy a deal today for 200.
South Atlanta, base of the Martini Glass, workforce demos, there's institutional owners in the comp set. There's going to be some point when they maybe come back. If they don't come back, you're still cash flowing. Bad debt, evictions. This is, to me, why capital has been scared to come into Atlanta. But it's also why we're seeing opportunity.
I can definitively say we are seeing a drop in bad debt.
If you're a good manager and you're on the ball and you have a good team on the ground, you can really do well. And if you don't have that, you could still get crushed.
As soon as third-party data reports show rent growth and show that bad debt that we're feeling and reaching the ground, it's going to become almost impossible to win a deal. They will come in droves once the data shows what we're feeling.
Which pockets of Atlanta are you most bullish on?
This is such a broker answer, but
everywhere.
I would say everywhere. Yeah.
All right, everyone, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and today we got Brooks Colquitt. Brooks, how you doing, man?
Good, David. Good to hear from you.
Good to hear from you as well. Brooks, I got to tell the audience, you were the first one to say yes on the pod. Due to technical difficulties, it didn't work out, but we have you now, and we're going to take a deep dive into Atlanta, which is one of my favorite markets right now. It's a little out of favor, but I think it's coming back, and Brooks is going to tell you exactly why, and this should be a fun one.
Looking forward to it.
Yeah, and first of all, a little quick intro on Brooks. We closed the deal end of last year in Atlanta, and Brooks just joined the NEWMARK office as a senior managing director. Before that, he was at Cushman & Wakefield for how long? 10 years?
8.5.
8.5 years. And you guys did over 60,000 apartment units, $4 billion in sales volume. And now you're in the NEWMARK shop and looking to do more business. How's it been at NEWMARK, by the way?
It's been good. So different model at Cushman. We were a very large team that had a revenue sharing agreement where basically everything went in a bucket. We had institutional capabilities behind us, just being a international company. NEWMARK has the same advantages. So it's an international company. It has plenty of resources, plenty of people. The difference is it's more of a traditional brokerage model where you control your state, you control your region, and you control your clients. And for me at my age, I felt like that was a better model just to get closer to my clients, be able to do business with people I want to do business with. So not either model is wrong, not either model is right. It's either right or wrong for the right person. For me, this is a better fit. So all good.
Yeah, and I feel like in brokerage, you're establishing yourself, you're creating your relationships, and end of the day, the jersey is just the jersey and the player is the player. And whether it's NEWMARK, Cushman, or wherever, it's always a pleasure working with you. And last deal was awesome to work with you and looking to do more.
Absolutely.
Let's dive in. I mean, the first question, obviously, I want to hear, 30,000 foot overview. Why Atlanta?
Yeah, sure. So I actually was born and raised in Atlanta. I spent a brief time in Charlotte, but really 25 plus years of my life have been spent in the city. And it's pretty cool to watch the growth. And one little small stat is since 1990, so the last 35 years, Atlanta has grown almost 300%. So the population was around 2 million. It's now almost 6.5. And I've been able to watch that really happen real time. Just for example, I was born and raised in Peachtree Corners, which is a small suburb of Atlanta, about 25 minutes north of the city. And when I was born, there was one public school, there was one office building, there was a couple of small gas stations. There's now 2 malls, 4 different public schools, 4 different office developments, tons of capital, institutional capital poured in the marketplace. And that's just one small neighborhood. But it's a good microcosm to show proof of how Atlanta has grown. In terms of why, number one, it's a right to work state, meaning there's no unions versus like a New York City or sometimes even in Chicago, Los Angeles. It's business friendly, meaning that a lot of these corporations like Coca-Cola, like Delta, they get tax incentives for growing their business here. And over the course of the last 30 years, that's why you've seen a lot of these Fortune 500 companies pour into this marketplace. And the biggest driver would be the airport. It's the world's largest airport. More people come through Hartsfield-Jackson than the other airport in the United States, even in the world. And because of that, it's easy for businesses from an infrastructure perspective to have outposts here or even headquarters here. And from a multifamily perspective, people can direct fly from anywhere, internationally and domestically into Atlanta. So it makes it really accessible just to come check your properties and come to Atlanta to look at a submarket, et cetera.
I would add to that the type of companies that are coming here. You could tell it's business friendly. I actually was in an Uber, kind of picking an Uber driver's brain on Atlanta, and he said how the film industry, I guess, gives an incentive if you do it in Georgia and show like that it's a Georgia film, you get like a tax credit. I wasn't sure exactly what it, but like little tidbits like that is what drives employers to come and put their base in Georgia and in Atlanta particularly.
Yeah, music and film are huge. I don't know the exact stat, but either Atlanta is second or third in the country from a film production standpoint. And I'm sure a lot of your viewers watch Netflix or XYZ show, and you'll notice at the end it'll say filmed in Georgia.
Mm-hmm.
And that's where the tax credit situation comes into play. And 35 years ago, that was non-existent. I mean, literally non-existent. And it's only growing. And so you have entertainment, film, and music, and not to mention all the Fortune 500 companies, but it's always been a dynamic city. And just real quick, it also has always been the largest city in the Southeast, and it will continue to remain that way. If you look at kind of the United States, New York is the largest city in the Northeast. Atlanta is the New York of the South. It's very diverse, tons of population. The net migration is still positive. It's a long-winded way of saying Atlanta will always be kind of the capital of the Southeast.
Yeah, and one of the business plans that when we were buying our deal together is also the logistic and distribution employers in the southern part of Atlanta. I think the connection it has to Port of Savannah and some of that growth has been another, we haven't even mentioned logistics and distribution. So I think that's important to talk about as well. Such a diverse employment and economic drivers where it's not just focused on one, but many other aspects in industries.
Correct. Yeah. And as you mentioned that, if you look at a map of Atlanta, which we'll cover later in this, but you have I-85, I-75, and I-20, all that merge in downtown Atlanta. And then you have I-16, which comes from the port of Savannah. And so you have 4 major thoroughfares that get to any city in the Southeast and any city on the East Coast, with the airport being here. And so, yeah, logistics, manufacturing is an absolute hub. And a lot of that logistics and manufacturing is south of the city. It's around the airport. It's basically McDonough north. There is some on the north side as well, but a lot of your industrial and manufacturing will be south of the city.
Yeah, so let's go into it. Let's pull up a map. I know the best way to talk about Atlanta, you gave a great analogy with the Martini glass. As much as I love martinis, I love also analogies to martinis to understand markets. So why don't you give the audience a little bit about how to break down Atlanta geographically?
For sure. So as you see in this map, there's Highway I-20, and that goes east-west or west-east through the city. That essentially separates the north from the south in terms of the city of Atlanta. Along Highway I-20, you have the east and western parts, which have their own benefits and their own job stories, but we're staying high level in this conversation. But anyways, so North Atlanta has been identified as the Martini Glass. And North Atlanta, if you zone in on the map, Highway 400, which starts in this really in Buckhead, but North Atlanta, Buckhead, it goes straight north and south. And a lot of people that live north of the city use that road to come in and out of work. It's extremely congested during
Mm-hmm.
the high traffic hours, but that is your stem of the Martini Glass. But basically, that center of the Martini Glass, your stem, that's going to have your highest per capita income. It's going to have some of your best public schools. That's going to be the highest rents in the city outside of your core in Midtown and Buckhead. But basically, you can't go wrong from a demographic perspective. You can go wrong from an acquisition perspective. Just because it's in that stem does not make every deal a good deal.
Mm-hmm.
Price is the determination of whether or not it's a good deal, and then the execution of the business plan. But in general, you will never see demographics that are not in a positive light. The demand to be in that area for capital is high. It just has a lot going for it. As we continue up the Martini Glass, you then have the actual glass, and that
Mm-hmm.
is a large circle anywhere north of I-20. And so you can kind of just take a circle around 285 and go up to Cartersville.
Yep.
That also is within the glass. Now, each side of the Martini Glass has its pros and cons. Like, again, just because it's within this metric does not mean it's a good deal. But in general, you'll see solid public schools, you'll see high demographics, plenty of jobs, just because a lot of people commute into the city, into Buckhead, into Sandy Springs. But a lot of capital flowed into North Atlanta. The one negative with North Atlanta is when the market was red hot and debt was essentially free, the highest price per doors were sold in this Martini Glass. And so when we're in a normal market condition, the price per door doesn't really have that much of an effect on the actual transaction. It's only when you're buying it at the wrong time. And so some of our clients are having issues just with basis. They're
Mm-hmm.
trying to refinance their loan. It has nothing to do with the performance of the property. That's the one thing I want to stress. It's just simply what they paid and what the cost of debt is today versus then. But in general, that is where you want to be in Atlanta from a demographic perspective.
Yeah, one thing about Atlanta is with values dropping nationwide tremendously, we look at trended exits and see how they were compared to peak. And I would say, like in North Atlanta, you're well inside of peak when you're on your trended exits because of how high those values ran up. My question to you is, in your opinion, do you think we'll get back to that pricing in the next 3 to 5 years from a price per door perspective? Not obviously not from a cap rate perspective, but just like that type of basis. Do you think there's a path to get there? Or do you think those price per pounds just ran up so high that it might take a little bit longer?
I would say in general, yes, we are a strong believer that it will get back to that pricing. There obviously are examples where it might be a long time.
Mm-hmm.
But I would say for the most part, yes. And there's math behind it. It's not just broker speak. Atlanta reached peak supply last summer, so the summer of 2024, and the projected number of units under construction coming online is projected to go down each month. in just a few stats. So in 2022, 26,000 units, 23, 26,000 units, 24, 25,000 units, or 23,000, I think it was the exact stat. This year, it goes down to 15,000, and then next year it goes down to 8,000, and the year after that it's projected to go to 4,000. That should change, but you get a general sense of how much construction is dropping, and yet the net migration in Atlanta is still positive. Population is still growing. Job growth is still there. The same Fortune 500 companies that were there 3 years ago are still there now. In fact, more are coming. And so because there is a lack of supply and demand is increasing, and a lot of that demand goes onto the north side of Atlanta in terms of where they live and where they work, we do see values going up. Whether that's 1 year or 5 years, that I don't know. But I do think we're at the bottom, and if not at the bottom, we're darn close.
Yeah, definitely. And I think part of that light at the end of the tunnel is kind of what you said, there was peak supply, whereas 20,000 plus units a year, but you're also seeing peak demand and peak absorption trailing that number. I think there was over 20,000 units absorbed in the same 12 months. So the fact that absorption is still kind of trailing, but nearby of peak supply is a good indication of how healthy the market is from a renter standpoint.
Correct. Yep, correct. And you'll see those stats in our OM as well. And that's, one of the benefits of North Atlanta is performance. So, and we'll get to the south part of the city and east and west. And again, every deal is different, but even at those high bases that were purchased, the performance has still been relatively strong. You're not seeing the 12% rent growth that we saw in 22 and 23, or 21 and 22. But overall, like, occupancies are healthy. The renters are paying rent on time. So it's being repetitive, but essentially you see good performance historically on the north side, and I think we'll see it in the future.
Let's move down to, I guess, the base of the Martini Glass, and kind of talk about some of the pros and cons there as well.
Yeah. So this is something that I've spent a lot of time south of I-20 in terms of just properties that we've sold. This is a very transactional side of Atlanta. A lot of the equity here is not as institutional as you would say on the north side. And a lot of those institutions are REITs, and they're 10, 15, 20-year holders, where it's hard to find capitalization of that. On the south side, there are institutions that own here, but in general, it's more private in nature, and therefore it becomes more transactional. And when the times are good, you can make a lot of money here because it's very easy to liquidate. And from a performance perspective, just like on the north side, there are pockets that are not as good, and then there's pockets that are really good. And so you still have to be careful of where you buy. Just for example, McDonough is looked at as a very positive market south of I-20. As David zooming in there, right now McDonough's overbuilt. There was a lot of supply because of all the demand and all the positivity that was in that market. Developers flooded it. However, this is just temporary. There's no issue with jobs. There's no issues with population growth. Right now, there is an issue with rent growth just because of the oversupply, but high demographics, very desirable subpocket. And as you go north to northwest, these submarkets benefit off the growth of McDonough. So that's like Stockbridge, that would be Jonesboro. Those neighborhoods are not as quote unquote great or high dollar incomes that you see in McDonough, but they're still very healthy markets. They also, in certain pockets of these areas, haven't seen the strong rent growth like what we saw in 21, 22 because of the supply. McDonough does affect these markets, but in return, as a buyer, buyers are able to pick up deals at a depressed basis. So Yeah, for example, like deals in this pocket, newer construction, we're trading in the 250, the 260 a door range. You can buy a deal today for 200.
Mm-hmm.
And again, the fundamentals haven't changed. The debt has, the pricing has, the rent growth has. But that's why we think it's a really, really, really good time to buy, because a lot of people are not. But when everyone was buying 3 years ago is when probably people shouldn't have been buying. And so we think it's a great time to enter that market.
Yeah, and I think there's a difference between a maker submarket and a trader submarket. And there's not necessarily like a good or a bad. Kind of like what you said, there's these boom bust pockets that are more transactional, more liquid, and it's not about timing, but it's just about being a little bit more risk averse, maybe going into those because you know you have the liquidity and you just if you're covering and downside protecting, you can do really well there. Whereas on a maker market, maybe if you're going long term and you have conviction, you might stretch because you're holding this in 10, 15 years. So I think what Atlanta has is an investment thesis for both, right? Whether it's
Yeah.
a good demo, high barrier to entry pocket, or maybe something that's a little bit more commodity product workforce, Atlanta has it for both, and there's both, benefits to either thesis.
Yes. Yeah, absolutely. And in general, and I know I'm a broker, and so we're obviously selling properties and we have properties on the market right now. But I truly believe if you just look at simple math, pricing is down 30 to 35% from where it was in 2022. All those stats I just said have not changed. Net
Mm-hmm.
migration positive, population growth positive, but the pricing is way down and debt is coming in. It might fluctuate, here and there, but in general, it's cheaper than where it was 12 months ago. And so, long-winded way of saying, whether you're buying in the north, whether you're buying in the east, whether you're buying in the west, right now is a good time to put capital into Atlanta, and we're seeing that. Our bid matrices last year, towards the end of last year, were pretty slim in comparison to where they were in 2022. This year to start, we have seen capital come back to Atlanta, and I think it's because of all those stats that we just mentioned, because of the compression in value, and because the city is so dynamic. So you summarize well, whether you're buying north, south, east, or west, there's all ways to make the deals work. You just want to make sure that you're buying the right property.
Yeah, I remember when you came up to me at NMHC this year and you're like, David, I have good news and bad news. The good news is that Atlanta, everyone is now talking about it because pricing is now reflecting of it to come back in. The bad news is it's going to get more competitive for you and for us to do our next deal together. I guess taking a step back a bit, you talked about how pricing is down 30, 35%. ZERP era, zero interest rate period versus now. What were cap rates before for, core plus versus value add before versus now?
There was no risk spectrum back in 2022. Essentially, everything was a 3.5 cap. It could have been a deal 1970s on the south side. It could have been something core in Midtown, Atlanta, high rise. Pretty much everything was a 3.5 cap. And now, granted, debt was 3.5. And so it was around neutral leverage, plus or minus. A lot of that debt, though, at the time was bridge. And so it turned out to be extreme negative leverage. But long-winded way of saying plus or minus 3.5, you would see some deals trade at 4.25 if it didn't have as much rent growth, but between 3.5 and 4.25. Now you're seeing cap rates for core deals in the upper fours still. I would say for your kind of workforce housing or your core plus value add, so something that's in a core location that's a value add, it is around a 5. And then your workforce housing value add is around 5.25. And then your true workforce kind of, maybe small unit count or in a rough location, that's closer to a 6. But we're not really seeing many transactions at all at a 6. It's in the upper 4s to mid 5s.
Yeah, I guess once you're pricing at a six, it's really that's where you just start to see the bid ask spread, right? That's where you're starting to see those groups not meeting the market, trying to find alternative capital to save the deal. Are you starting to see that change from the value add side of where you're BOVing a deal and maybe sellers are starting to capitulate and they're starting to say, okay, we're in 2025. This is the year where we said things will be better and we're here now. We got to meet the market. Or are you still seeing the bid ask spread continue?
It's painful to say. I would say we're still seeing it continue.
Mm-hmm.
There are circumstances and deals that you see on the market today are normally deals that they're going to meet the market. They're going to transact. Last year and the year before that, especially 2023, so many deals were pulled. I mean, 50 to 60% of the deals that hit the market were never traded. Last year was probably 50%. This year, I think you'll see a much higher hit ratio because of everything you just said. However, the amount of BOVs that we've done, just for example, I started at NEWMARK 2.5 months ago, and me and my team we've done 72 BOVs in Atlanta in 2.5 months, and we have 2 deals on the market. And so that's an example of our hit ratio from a sales perspective is still low, but those 2 deals we have on the market will transact.
Yep.
And I don't know what it's going to take in order to get, say, half of those 72 on the market. That was kind of our old hit ratio. It's likely time. The more time that goes by, sometimes is a good thing for sellers, but more often than not is not. And so, next year we're hoping that changes, but it's a very fluid situation.
I think the BOV activity is groups trying to understand pricing in such a volatile time, right? And trying to get real-time feedback on their deals on the market. Does that translate to sales? Who knows? I think at some time in the next maybe 3 years, I don't see rates dropping, precipitously anytime soon. So I think we are in a new reality, and I think that might start translating to people just starting to turn those BOVs into marketed opportunities, but only time will tell. Brooks, we gotta address the elephant in the room about one thing that I think it's not fair to say has changed since the peak, because I think it was going on in peak, but bad debt, evictions, this is to me why capital has been scared to come into Atlanta, but it's also why we're seeing opportunity. So talk to us about the bad debt story, where it started, where it's at today, and kind of looking forward how it's going to look.
Sure. Yeah. So I would say at its height, which would have been, call it late fall of 21. So a solid, kind of year after COVID, or really when COVID came to an end, at least in Georgia, we were probably 18% delinquent as a market as a whole. Now today, I haven't looked at the latest stat, but end of last year, we're more like 7%. And that's just as a whole, right? So every submarket is different, but
Mm-hmm.
it's cut 11%, and it's dropping. So the one thing I can say for sure is we are not seeing rent growth yet. That will, in our opinion, start this summer and really hit hard next summer because that drops supply. But I can definitively say we are seeing a drop in bad debt. And that's given a lot of buyers confidence. It's given people, they were hopeless in terms of, okay, I see I can stabilize this deal at an 8 cap, but can I? I can't get these people out. People are now able to do that. And what's helped is counties are helping out landlords. Fulton County signed a new writ law, basically saying any off-duty officer can evict a tenant as long as that writ is received by the landlord. What happened was when off-duty officers came in and evict tenants, everyone else would skip that hadn't paid rent. And so you saw a massive increase in evictions, which also increased bad debt write-offs. But in the end, it's much healthier for the marketplace. So I would say by the end of this year, you'll see it on CoStar, Yardi Matrix, whatever third-party data report you see. That bad debt figure will be back down into the 4-ish range. And historically, Atlanta always was sub 2. 0 to 2%, depending on the submarket. We will get there, probably be at the end of next year, but we're much better from an operations standpoint than where we were 3 years ago.
Yeah, I would add to that, we track a lot of markets, and what we're finding is Atlanta's problem with bad debt isn't unique at this time. We're starting to see the delinquency trickle into where you were before in Charlotte, in other major metros, even in Florida. Now, Atlanta was a little bit more backlogged with, the court dates and getting the writs, but the bottom has already been seen there. And I think you're already seeing such drastic improvements where these other markets, even Denver, are just getting wind of it right now. And they're just dealing with it now. So people have this stigma about Atlanta and operations, and it's real. It's still hard. If you're not on top of it, you could get crushed. That's why us at Tryon, we self-manage, and we're bullish on Atlanta because we have a firm grasp on operations, but it's a problem that is not unique to Atlanta at this point.
Yeah, it's interesting. Yeah. And we've heard similar feedback from clients. And again, that's why our bid sheets have increased, just because they're like, you know what? Atlanta has not solved the issue, but come very close to fully solving the issue. It's in process. And, if your bad debt is 4%, that's a very reasonable number to overcome, versus, 20, 25, 30, 35%, like we were seeing on some AR reports. And that still is on some properties, but there's two common themes to those properties. Number one, bridge loan. Number two, sponsor out of capital. And you put that together, they're not turning units. The management company has an account payable balance north of 500 grand. And those properties are now being foreclosed on by lenders. They're being sold by that current sponsor. They're being reworked from an equity position where someone with capital comes in. That has also tremendously helped performance, as a lot of that happened last year and early this year, is getting some of those sponsors that were just in a bad situation out, which helps the overall market as well.
Yeah. And, in Atlanta, you're seeing those distressed deals one way or another. And again, we talked about this already, but may or may not translate to a sale. I guess at this point, how much distress is due to the market at this point versus the sponsor and running out of capital, not having any more money to fund turns, things like that? Like, what would you say is the ratio at this point?
It's a good question. I would say it's very rare to see a property with an owner that has capital or that's still basically operating the deal. It's very rare to see extreme bad debt figures on those properties. I don't know the exact percentage. I would
If
say
they have
less
the
than 10.
capital. Exactly. Like if they have
Yes,
exactly.
less than 10%.
Yep. Yep. Yeah, I agree. I mean, I think coming out of COVID, it was a little bit, backlog. The market was tough. It was tough to evict. At this point, Atlanta's caught up where it's really sponsor driven if a deal is truly distressed. I think market bad debt, as you said, it got cut in half. I think in some counties it's even better than others. So it's an opportunity where if you're a good manager and you're on the ball and you have a good team on the ground, you can really do well. And if you don't have that, you could still get crushed. If you're not capitalized, you could get crushed.
Yeah. And I will add to that, and you said it before me. The key is the people on the ground. We are seeing a property on one street where it's 96% occupied and it's got 1% bad debt. And the property next door, same vintage, is 80% occupied with 4% bad debt. And it really comes down to the people and how that organization is laid out. That is definitely still a very important factor. And if you have that before you come into Atlanta, or if you're in Atlanta, you can really, really do well here. But that's also, I wanted to touch on that. That is important, is the people actually operating the property.
One thing that attracted us about Atlanta and deals in particular is you're seeing a lot of institutional capital that own in Atlanta, and they've owned historically, but you're seeing right now that they might be a little skittish from the reasons we just spoke about. We spoke also about how people are starting to itch back into coming to Atlanta. When do you see the full-blown institutional capital that are in the rent comps starting to come back and actually buy and not just put bids, but actually start buying and make big bets in Atlanta? When do you see that playing out? Do you think that's this year, next year? Is it already happening? Like, what are you seeing boots on the ground?
It is already happening, but it's not happening at a rate where it's becoming I would say too competitive is the best way to describe it. So, for example, most of the deals that they're bidding on, they're on the sheet, but they're still not competitive. However, we have seen institutions become competitive now, but they're not buying at the rate they were. Here's the answer. As soon as third-party data reports show rent growth and show that bad debt that we're feeling on boots in the ground, it's going to become like almost impossible to win a deal because they're going to put all their bets in Atlanta. The data is going to be driven. And what we've been telling our private clients is most of our clients happen to be private in some nature, is, you know, being entrepreneurial, looking at what is happening at your properties, being boots on the ground, trusting your broker, trusting your property management company, trusting your regional, get ahead of it because we all can feel it happening, but the institutions kind of act on data.
Yeah.
And so to answer your question, they will come in droves once the data shows what we're feeling.
Yeah. And I think that's where, a niche company like us, like at Tryon, where we're vertically integrated and we're kind of seeing things firsthand before it hits the data set. Um, just we can track when we're approaching a fallen knife. We can also see things when we're starting to see positive trade outs. We get to see both sides of it. And that's where we get to place our bets early before the institutional capital comes and start flooding in. By that point, it's game over.
There is some positivity to that. You'll see cap rate compression. And so if you're buying now, you're going to get the benefit of that of when you sell. Is when they come into play, the regional players go down to 80s. The private, more local guys go down to 70s. All of a sudden cap rates start compressing. And so that's just another reason of why it is really a good time to put capital into Atlanta before that all starts happening.
The deal we did together, it's, early 2000s, 9-foot ceiling product. South Atlanta, base of the Martini Glass, as we were talking about, workforce demos. But that 9-foot ceiling, early 2000s product, there's institutional comps, owners in the comp set. There's going to be some point when they maybe come back. If they don't come back, you're still cash flowing 6-7% cash on cash today with rates as high as they are. And the hope is, maybe you can even refi into something lower. If that institutional capital doesn't come back, you're still cash flowing. But I think if and when that institutional capital comes back, you're going to definitely see that 9-foot ceiling early 2000s product cap rates start to compress drastically.
And they'll start in kind of your bulletproof locations where it's all, not all institutional, but for the most part. Once it becomes too competitive for them, capital disperses. But the good news about your property in particular, and really South Atlanta, is there is always capital chasing that. I want to be clear, like just because we're in a quote unquote down market does not mean that you can't liquidate. And just because the institution is not looking at it does not mean you won't get paid an institutional cap rate. That's one good thing about Atlanta. It's a national market. Everyone looks at it. It gets a lot of eyeballs. And so to quote unquote time it perfectly, you're right. You would want someone with the cheap costs of capital to buy your deal. But that doesn't mean that you can't get a similar cap rate before that happens.
You mentioned bulletproof markets. I want to ask you, as someone who's covering a lot of markets, which pockets of Atlanta are you most bullish on?
It's a great question. I would say, this is such a broker answer, but
Everywhere.
I would say everywhere. Yeah, everywhere there's a lot of. I'll put a lot of facts behind this. As long as your basis, it doesn't necessarily have to be day one yield. day one yield is always a positive thing. It de-risks you, like you said. If you can't sell it, it still cash flows. It allows you to refi, etc. Sometimes low basis, if you can't stabilize it, if you can't get the rents to where you need to be, you might not be able to refi at a position that you underwrote. But in general, and based on what we've seen in Atlanta, as long as you're buying at a basis that's relative to COVID-esque trades, so call it like 2020, 2019, even early 2021, before the market went berserk. If your pricing is at that range, you're getting a hell of a deal because rents moved 50% almost in certain properties. In general, the market moved about 27%. So if you're buying a property at that same cost from that time to today, you're getting a great deal. It's hard to find those. Normally, say a property traded in 2019 for 150 a door. Today, it's worth 180. But if you find something in between that 150 and 180, it's a great basis. So long-winded way of saying there's not a county or a spot that I don't like as long as you're buying at the right basis.
Yeah, I think, listen, I know as a broker answer, I'll let you off the hook, but I do agree with that. I think when you're looking at these sale comps and then you're looking at where you're buying and then where you're moving NOI and you're putting a cap rate that's a reasonable cap rate, probably when you're putting, no cap rate compression in a trended rent in 3 to 5 years and you're exiting where deals were trading 3 years ago, that feels pretty good. You're buying something with an impaired NOI, with elevated bad debt, with elevated vacancy due to the supply, elevated bad debt due to coming out of COVID. And you're doing real management operations for upside. We're value add guys. So moving the NOI without having to bank on a reno play, obviously that might come down the line, but just improving operations and moving the NOI and then putting it at an exit cap that's similar to where your impaired NOI was, and exiting at where deals were trading at from a basis standpoint, that feels pretty good to me. And so as a value add guy, you're bringing in the value by improving operations and you're conservatively assuming exits where you're not breaking records on that.
Yep, correct. I kind of describe it to some of my clients where at this point in the cycle where we are today, there's too much that can go right to make the investment work versus that could go wrong. And for example, in 2022, you're underwriting 15% rent growth the first 3 years. You're underwriting a $300 rent bump on value add. You're underwriting a compressed cap rate on the exit or a cap rate on the exit that has historically lower than they've ever traded. There's all these things. Now, all the data pointed to that, but there was a lot of what ifs that could go wrong to make that what seemed like a good investment a bad investment. Right now, a lot of the what ifs or situations are positive to that buyer. For example, if you're underwriting to a cap rate, say at 6, but yet for the last 5 years, it's all traded at 5.5. You have to underwrite the 6, but if it works at a 6 and you get a 5 exit, you're going to be really happy. If you're underwriting for $100, $200 rental increases based off XYZ comp, well, that XYZ comp goes through a lease up, and all of a sudden they're turning their rents, and there's just too many things that can go right to make your investment very good versus to where we were a couple of years ago. So again, it's kind of back to that theme where we really think it's a good time to buy.
Yeah, it goes back to, protecting your downside. And if you're protecting your downside now, then it's going to pay dividends when the market recovers, not matter if, but when. So, Brooks, it was awesome having you. Thanks again. Looking forward to this year. You want to let the audience know how can they get a hold of you if they want to learn more about Atlanta and some of the opportunities you have?
Yeah, sure. So, David, feel free to share my information, but I'm in the NEWMARK office in Atlanta. My email is online. You guys can just look it up on the NEWMARK website. Cell phone's on there. Call me anytime if you guys have any questions. if you're ever in Atlanta, feel free to reach out. I always answer my cell phone, no matter like what time of day it is. So give me a shout, and look forward to connecting.
Awesome. Brooks, thanks again. Hopefully we get another deal and we could get another round of golf. Everyone, Brooks is a scratch golfer. So if you close the deal with him, he might kick your ass in golf.
Hopefully my cap rate or my cap rate, hopefully my handicap goes up and cap rates go down this year. That would be great. Yeah.
Awesome. All right, Brooks, thanks again.
Thanks, David.